Hi, it's Amanda DeVito Parle. Welcome to my podcast, At the Kitchen Table, where we will guide, inspire, and connect.
Hi, how are you?
I'm doing great, Amanda. How are you?
I'm good. Well, I'd like to welcome Greg Osborne to At the Kitchen Table, which is our podcast. We just try and connect and inspire entrepreneurs. And we are, on the whole, we're just trying to educate people and open up conversations with interesting folks. And I called you today because we're pals and have known each other a long time. And so Greg Osborne runs a company called Bridge Capital Resources. What does Bridge Capital do?
Bridge is a private lending company. So I make short-term loans to small real estate investors.
As opposed to long-term loans to the public.
Yes, I don't do any consumer lending. I'm technically a commercial lender because I make loans to investors only for investment properties only. Most of these properties are single-family residential units, versus large commercial buildings because I'm a small private lender.
Right.
But I don't make any consumer loans. The Dodd-Frank financial reform law changed all that years ago. So I make loans on investment real estate, primarily houses, to small investors who can't get traditional financing.
Okay, and what do they do with the houses?
Well, there's always a value add strategy. So they make an investment decision and then deploy their value add strategy. A lot of time that strategy is fix and flip. They'll buy something that, basic fix and flip, or they'll buy a rental and tidy it up and try to achieve market rents and hold it for the long term, and then they'll refinance me out once the property's stabilized, and a more traditional lender can do a traditional loan with like seasoned rent history.
Okay.
So they're either fix and flips or rentals, basically.
Right. And these are short-term loans at high interest rates.
Higher interest rates, yes. So I'll make loans from 1 day to 1 year. That's
Okay.
kind of my sweet spot, and 6 months is typically the target. Mm-hmm. You do pay a premium for hard money or private money in exchange for two significant conveniences. One is the speed to close. Private lenders typically move much faster than traditional lenders who take 30 to 45 to 60 days to close.
Right.
And investors typically in this market don't have the time to wait 30 or 60 days for their deal to be accepted by the seller. Mm-hmm. So they'll come to a short-term lender to say, hey, it's basically a bridge loan between acquisition and stabilization. So they pay a premium for the speed to close. Typically I need 5 days from application to close. My record is 29 hours from application to close.
That's fast.
And so you pay a premium for that convenience. The other portion of the premium is related to the collateral-based underwrite. I don't underwrite the traditional 5 C's of credit that a typical mortgage lender will underwrite. The 5 C's are credit, capacity, cash flow, collateral, and character. I underwrite collateral and character.
Right.
So you pay a premium for that. So my rates and my colleagues in the industry's rates are typically higher than what a consumer or even a bank lender will make on an investment property. And therefore you don't want to linger in hard money. You want to use it. You want to be in and out. And my best borrowers get in and out quickly because they understand they're paying a premium, but they need the convenience. So speed in and out is critical in using hard money.
Right, and it's a high-risk business, too, because there's volatility in the markets. I guess, in a way, the shorter the term, the less volatility, right? Because
absolutely,
you can kind of predict the markets right ahead of you, right in front of you, as opposed to what's going to happen in a year or 2 or 10.
Yeah, my biggest risk is execution risk, meaning can my borrower execute their stated business plan on time, at or under budget?
Right.
That's my biggest risk. It's also their biggest risk because if they can't execute their business plan within the term of the loan, the freight gets awfully heavy.
That's right. And if somebody gets into the heavy freight territory, that's very punitive for them and it's expensive. And I mean, it can sink a whole project basically, right? I mean,
absolutely.
Yeah.
Really, interest carry, no matter what the price is, can destroy any project. I mean, You've got, time matters. I mean, you've got to execute, regardless of who your lender is, you've got to execute your business plan with the agreed upon or projected time frame so that interest carry at whatever rate you're paying doesn't devour your profits.
Correct. So you're doing these kind of bridge hard money loans for fix and flippers, mostly local, or like a handful of the same guys over and over again often call on you. You're leaning into your network to fund or source the business essentially. And this is your small LLC that you are self-managing. So that's all true, right?
That is all true.
But where did you come from, or how did you get to know these things, or how did you come into this business?
Where did I come from? How much time do we have?
Yeah, just go back to the banking part, not all the way back to your mother.
Exactly. No? I think it goes even before that. So I'm a career mortgage banker. Most of my 40 years in the business were spent in the consumer mortgage banking business,
right,
either in the retail channel or the wholesale channel. I left corporate America, I guess it's been almost 14 years ago, 13 years ago, and I started this little private lending business. So all of my training and my professional career training has been in real estate lending.
Right.
And I decided, at age 50, I was done working for the man and wanted to work for myself. And the universe conspired to make that happen.
Great.
And I started this little short-term lending business. It's funny, the way I started this business is I formed the company, I produced a website, and I started with LinkedIn sending direct messages to my contact database, starting with AA, and saying, hey, here's what I'm doing. Here's a link to my website. If I can help you in any way in this little sphere, let me know. And I just kept sending these messages, and by the time I got to O in the alphabet, my business had blown up. It's taken off. Right. So it's a referral-based business, much like yours is.
Yep.
Started with my sphere of 35 years of mortgage banking colleagues, and has now, after 13 years, I have a very loyal base of repeat customers that come back to me, and that's in part because I want to not only fund their projects, but I want to educate them on, whether their deal makes sense from my perspective. I do a lot of analysis. I'm a little bit anal. I do all my own underwriting. I do my own valuations. And not only do I run my numbers when I'm analyzing a deal, I run my borrower's numbers and say, hey, look, if you're a fix and flipper and this is your plan, this is what you're going to buy it for, and this is what you're going to put into it, and you're going to get it done in 6 months, here's what I see, including interest carry, your net profit to be.
Right.
So I do all of that up front. And I advise my clients, look, from my analysis, you're overpaying for this project or you're overspending on this project, and you need to adjust your numbers here so that this project works for you.
Well, and you're looking ahead unemotionally. Sometimes they're emotional because they see a house they think will be exciting or a project they are excited about doing, but maybe the numbers don't make sense. And so to have this sort of rational person on the other side to say, like, I looked at the numbers, I'm trying to figure out if this math makes any sense for you. I don't want to invest in a project that's not going to be a winner for you and for me.
Right.
Because ultimately, if the investor for whom you're lending money to can't make money, they don't come back.
Exactly.
And so it has to be a win-win for everybody. You have to
Absolutely.
be looking ahead for those people.
And I do. I mean, I don't know much, but I know this. The only number I've got to get right is, what is the property worth 6 months from now fixed up?
Right.
That's become a harder and harder number to determine. I mean, I don't need to tell you that valuations in the, 11 county metro Denver area have just gone off the charts.
Right.
And that's not just after repair valuations, but it's also, acquisition prices. In my experience, many sellers of real estate that is in less than prime condition have gotten a little bit unrealistic on what the market will bear once the investor makes the investment to fix it up and takes the risk of doing so. It's just like any other negotiation. Look, the numbers either work or they don't. And I am dispassionate about it because what I want is I want repeat customers. My remedy as a private lender is to own the real estate.
Right, which I don't want either. You're in the business of lending money, not owning houses.
Exactly.
Yeah.
That doesn't mean I haven't had to foreclose and finish projects. Those have been very painful and expensive lessons for me.
Sure.
But that's my remedy, and if I have to do it, I have to do it. But if I'm doing my job up front right, and I'm running numbers, good numbers, using good comps, I like down to the subdivision comps,
right,
if I can find them, I can advise my client that, look, assuming past comps, because I've got to use solds, hold up 6 months from now, your project ought to be worth this, and this is your margin based on the cost inputs that I've put into my proprietary model, and this ought to work. Now it's up to you to execute and get it done and not overspend. That's the risk I see more than anything. I think, people look at these home remodel shows. What's the name of the?
Yeah, right. Yes, like all these HGTV stuff. I don't even know.
Exactly.
Yeah.
Everybody loves the transformation. Who doesn't love the transformation of a lousy house in bad condition to a wonderful home for a family?
Right.
The problem is, investors have X to spend on their fix-up, and they've got to get the basics right. I don't need to tell you, but curb appeal, kitchen, and master are the primary drivers of what sell a home.
Right.
And if you buy a piece of real estate that needs not only that, but electrical and a new roof and all the other stuff, you've got to buy it at a deeper discount to cover those costs. And where my borrowers get in trouble, or any investor gets in trouble, is overspending, beyond the basics. Get the basics right, deliver a quality home, but focus on curb appeal, kitchen, and master.
I want to pivot away from the fix and flip stuff, and I want to move to a conversation that I always find interesting whenever you and I are together, which is this sort of underlying conversation about the markets. I feel like you have a different and deep knowledge of sort of where the banking industry came from, consumer lending, private lending, and then lately there's all these conversations about the market's behavior. And so some of what you do in your business is very predictive, right? You just finished saying, I have to be able to anticipate these market conditions. I think some of the reason that you're so good at what you do is because you know this sort of deep underlying stuff. And I think a lot of people have questions about common terminology that's used in real estate that a lot of us don't totally understand.
Okay.
And so I wanted to shift you into helping me understand and the listener understand the effects of the stock market against the real estate market against the bond market. What is the difference? There's these little nuances that affect real estate. And then I want to talk a little bit about the Fed, how underlying interest rates, well, you can even start back with how did the Fed come to be? How did they take us off the gold standard? And maybe that's the place to start, because I have these deeper questions about that. So maybe let's just start there. What is the Fed and what do they do?
You've asked a series of enormous questions that arguably cannot be answered in the time allotted.
Okay.
But they're all the relevant questions.
Okay.
And everybody's trying to figure out the answers to those questions, because the current economic landscape, in my view, is treacherous. And I'm an optimist. I've always been an optimist. But the economic landscape at present and in recent years is really treacherous. And the market is also perceiving that and trying to assess risk, which is why you see prices and yields and all the fluctuation and crazy stuff that you see, because everybody's trying to determine that, including people a heck of a lot smarter than me with a lot more money than me. To answer your question, what is the Fed? The Fed was created in 1913 after the 1907 crisis to serve as basically the nation's bank and to add stabilization to the banking industry, which had experienced a period of instability up to that point. The Fed was created, their mandate is to stabilize prices and maximize employment. That's their mandate.
Okay.
They do a lot more than that.
Okay. So when you hear people talking today, you hear people say the Fed is adjusting rates or the Fed's moving rates. Why do they move rates and what are they doing? What does that mean? And what is that rate they're talking about? Because they're not talking about credit card interest rates. They're not talking about mortgage interest rates. They're talking about the Fed fund rate.
Correct.
So what is the Fed fund rate and why do they tinker with it?
That's a great question. The Fed funds rate is the rate that the Federal Reserve, the bank of last resort, charges its lender banks for overnight loans or pays them on overnight deposits.
Meaning Wells Fargo wants to borrow money, wants to lend out money, they're going to add the Fed fund rate to their rate because that's the money for which they borrow it from the federal government?
Yeah, it's their cost of funds from the Federal Reserve.
Okay.
And then either they or the market adds a premium beyond the cost of funds that is associated with the risk of the investment that the bank want to make, whether it's a credit card or a mortgage or something else. There's a risk premium that's added to the Fed funds rate, it's together with the inflation premium that ultimately ends up as the price to the borrower for whatever instrument we're talking about.
So let's just dumb it down a little bit. Fed fund rate is at what today?
It's always a range, roughly 4.5%.
Okay, so 4.5 is the Fed fund rate today. And if you, and the bank, let's say in this case, Wells Fargo wants to add 2 or 3 points on top of the Fed fund rate, that's their profit essentially, right?
It's their gross margin from which they have to pay their expenses and cover the inflation premium from which there ought to be a profit at the end of the investment.
Okay, at 4.5 plus 3, your rate shows up in the mortgage industry at 7.5.
So let's back up a little bit, because the only rate that the Federal Reserve controls is the Fed funds rate. All other rates are set by the market, quote unquote, the market.
Okay.
The biggest question right now is, the Fed is they've just come off a period of increasing rates. So for much of 2022 and 2023, they were increasing the Fed funds rate in an effort to head off inflation, which had reared its head after decades of easy money, zero interest rate policy. They call it, ZIRP. And inevitably, zero interest rates or low interest rates can lead to inflation, and lo and behold, it did. So the Fed, and we don't have to go into COVID and all this stuff, but an enormous amount of liquidity was injected into the system since the Great Recession of 2000 and 2008.
Right.
And inflation did rear its ugly head in early 2022, and the Fed began raising the Fed funds rate, upon which all other rates are set through the market. And then at the beginning of, I guess it was middle of last year, the Fed reversed policy and started cutting rates. The biggest question right now is, why aren't mortgage rates responding to the Fed rate cuts?
Right.
So mortgage rates are tied to the 10-year Treasury, which today is around 4.79%. That's a market rate, not a Fed rate. The Fed can only influence longer-term rates. The market sets longer-term rates. Mortgage loans are typically priced off of the 10-year yield. So if you buy a 10-year Treasury and it's yielding 4.79%, Treasuries are supposed to be the risk-free investment. Why? Because they're backed by the full faith and credit of the United States government. That's as risk-free a return as theoretically you can get in the marketplace. If you're going to make mortgages, there's added risk, which goes back to the 5 C's of credit we just talked about. The creditworthiness of the borrower, their ability to make payments. So there's all this other risk that a lender needs to be compensated for over and above their cost of funds, which would be the 10-year Treasury, that has to be priced into mortgages. And so in the past, and most of my mortgage banking career, when the Fed starts to cut rates, the 10-year responds accordingly. They would also drop. And everybody was hoping for that in our industry, but it didn't happen. And the question is why? Mortgage rates, I think I'm not in the consumer business, but they're roughly 7%, high 6s, 7%, and the Fed's cutting. And the market rates, mortgage rates, have not dropped commensurate to the short-term rate being cut. Mm-hmm. Why is that? I've been pondering this for quite some time, and the only answer I can come up with is it's because the markets perceive greater risk than what the Fed perceives by cutting rates. Mm. And in my opinion, the risk that the market perceives right now is that inflation is not tamed. And how could it be with a $36 trillion federal debt? So the market is checking the Fed saying, okay, you're cutting rates, that's all fine and good.
But we don't see it.
We don't believe that you've got inflation tamed. And to put our money out for that long, we need a premium to cover our risk.
Because the rate is the only tool in the inflation tool belt. So tinkering with the rates is really the only ammunition they have to fight inflation. Are there other ways to fight inflation?
There are other ways to fight inflation. It all comes down to injecting or removing liquidity from the market.
Okay.
There are a lot of ways to do that.
Money in, money out.
From a macro sense, I'm talking like M2, M3, money supply. And what we've seen, particularly since the Great Recession, and even more so through COVID, was a massive injection of money supply into the system, so that the economy would hum along, in accordance with the Fed mandate. Once inflation reared its ugly head, the Fed realized, we need to remove liquidity from the market so that we can tame inflation. And they do it a number of ways, certainly by changing the Fed funds rate, but they can also do it by removing money supply. I mean, typically they remove money supply by using the Fed funds rate. There are certainly other ways, buying or selling their own holdings, because the Fed's a huge owner of U.S. Treasuries. They are a huge owner of mortgage-backed securities, and they can either buy or sell their own holdings to influence money supply.
So why is it then that we keep spending money? I mean, this is the other thing, is that the spending is infusing money in, right? If you're trying to constrain the money supply, if the Fed's job is to pull the money supply in, thereby tinkering with the rates and pulling back to calm inflation, we just can't, universally, you just can't spend money that actually, that like throws fire onto fire, basically, right?
Exactly right.
Yeah.
So there's a key distinction to be made here, and that is the difference between fiscal policy and monetary policy.
Okay, what is the difference?
Monetary policy is the policy set by the Federal Reserve. Fiscal policy is government spending, which is controlled by Congress.
Okay.
And that really is the crux of the issue right now, because Congress has been out of control spending money for as long as you and I have been alive.
For sure.
And that's why we have not only a budget deficit of $3 trillion, but we have a debt of $36 trillion, which seems to grow by, $7 to $10 trillion every administration. And so, and this is another reason why mortgage rates haven't responded, because the Fed can do what it does, but until Congress does what it's supposed to do by restraining spending and getting our budget deficit in line and getting our debt in line, the markets,
they just don't believe them, right? They don't believe it.
That's the bottom line.
So is there, okay, I'm going to throw a big question at you.
Okay, I'll do my best.
Is there actually any way to get the $36 trillion in federal debt under control or paid off in our lifetime?
That's an enormous question.
I'm sorry, I knew it was big.
$36 trillion is a staggering amount of money. And I asked myself in my times of reflection on this, are we really ever going to repay the debt? What's happened heretofore is no, we haven't repaid it. We've recycled it. We've refinanced it by issuing new bonds or new debt. We basically when a certain series of treasuries come to maturity, they're paid off by the issuance of new debt.
Who is the debt holder? I mean, I can only think of debt in the way that if I borrow money from you and I have to repay you, that's Greg's money. Amanda has to repay it.
Right.
So whose money is where is that? Who's the lender of that, and where is it? It feels like such a phantom amount of money.
Phantom is the right word. It's staggering, and it's hard to get your head around. The borrower is the U.S. Treasury, so they're the ones issuing the debt. The lenders are the purchasers of that debt. So whoever's buying Treasury notes, bills, or bonds, either short-term or long-term U.S. Treasury, those are the lenders. And when it comes time for when a bond matures and the lender needs to be paid off according to the way the agreement, as it were, how does the government pay them off? They issue a new loan. They issue new debt, which other investors buy and retire the old. This is the issue, and as bad as the debt problem is in the United States, It's worse elsewhere in the world. The world economy is fueled by debt. And you and I are prudent borrowers as responsible homeowners and business owners. I mean, when we sign a note, we fully intend to repay it either through the sale of the asset or through the refinance of the debt or what have you. I'm not sure I can say that about the federal government, the borrower, because they keep spending money and issuing new debt that will it ever be repaid? I don't know how. So the question is, when does the musical chairs stop?
Correct.
So when do lenders say, I'm no longer confident that in the full faith and credit of the United States government? And I think that's the reconciliation that is both occurring now and more so in our future. And that goes back to the issue of mortgage rates right now, because lenders or purchasers of 10-year treasuries are demanding a greater premium for taking 10-year risk on a note than they were in the past. You saw the yield curve. The term the yield curve.
Well, and I want you to define it before you keep going. But yes, so keep going. And what is the yield curve? Okay.
So the yield curve basically is the plot of interest rates on federal debt over time. So on the short term, you've got 1 month treasuries, and on the long term, you've got 1 month treasury bills, and in the long term, you've got 30-year treasury bonds. And so the range of maturities of treasuries at issuance and the yields on each of those instruments plotted on a chart is the yield curve.
Okay.
And in a normal environment, you would expect if I'm going to make a loan for 1 month, I'm taking less risk than if I'm going to make a loan to the government for 30 years. A lot can happen in 30 years.
Right.
So you would expect interest rates on short-term debt to be lower than interest rates on long-term debt.
Correct.
Right? Makes sense? That's the yield curve.
And so sometimes you hear people say that the yield curve is inverted.
Yes.
Which means that the short-term debt costs more money than the long-term debt.
Correct.
When it's inverted, right?
That's correct. And the yield curve was inverted until I think it was December of 24 when it uninverted.
Okay.
So
But the speculation around an inverted yield curve is that what lies ahead?
a recession.
A recession.
Right.
Thank you for coming.
Thank you for having me.
Greg
You asked
Osborne.
hard questions,
Yeah.
Amanda.
And I thank you for your really insightful conversation. Thank you, and we'll look forward to doing this again.